The biggest winner in the Dow this week was Disney, while Cisco was the biggest loser. Over in the S&P 500, CA Technologies was the big winner of the week. And Broadcom, the acquirer of CA Technologies, the biggest loser on deal news. That was the story, of course, yesterday. Evan, the market climbs the wall of worry again, this time when it comes to trade concerns, and we end up with a really strong week.
Yeah.
Why?
Yeah, I think, well, the market right now, there are two big questions. Will there, won't there be a trade war, and if so, what magnitude? And the second is, why is the yield curve so flat? And the market, the equity market, for whatever reason, is finding answers to those questions that it's happy with. It's basically saying there will be no trade war, and the fact that the yield curve is so flat is not an indicator of future economic troubles ahead. And those two answers is the only reason why if you answer either of those questions to the negative, the market should not be at over 2,800 on the S&P 500.
Jeff, weigh in on that. We obviously have had some parts of this market that did get punished pretty harshly based on the fears of potentially an open-ended trade war. And of course, the flattening yield curve has been kind of an overhang, at least psychologically, for a little while. But of course, it has in prior cycles too, and it hasn't necessarily been flashing red. So do you think this move to 2,800 in the S&P means we're just at the top of a trading range, or are we going to build on from here?
I've said it since on this show we called the bottom on February 9th, that we think you're going to trade out to new all-time highs. The major averages have kind of lulled investors to sleep, thinking the markets haven't done much this year. But if you look at the S&P mid-cap, small-cap, the NASDAQ composite, they've all traded to new all-time highs. The advanced decline lines, except for the Dow AD line, have traded to new all-time highs. There are stocks in our portfolios that are up 100% this year. So it's been a stealth bull market, and I think we're going up and make new all-time highs.
Jeff, then what do you make of the weakness in financials, and in particular today's reaction to what, again, was better earnings and better fundamentals, including loan growth?
Yeah, well, I think too many people were staring at the yield curve and worrying that until it steepens, the financials are not a place to be. My dad used to tell me, however, that good things happen to cheap stocks, and the financials are cheap, and we have been buyers.
Evan, I know you love the big bank stocks. You think the business model is just built for these times? And,
you would think. No, here's the thing. The XLF, to Jeff's point, the XLF is down 10% from its highs. Yep. I think it was somewhere around $30, and now it's down around 27, right? That should not be happening in a world of 3% plus GDP growth in the U.S. I'm not saying I have the answer for why that is happening, but those two things, if you had Jeff on at the end of last year and you had most of the relatively bullish market analysts on, they would have said to you, you have to be in financials. Right. That is exactly the place to be, and they've been wrong. I'm not saying that they won't be right in the future, but it doesn't fit that the financials are doing this poorly.
On the other hand, the XLF's up 10% on a one-year basis, Jeff. So what did we have? Just a trade that got a little bit ahead of itself and is settling back right now? Or do you think that, weak banks, underperforming banks, from time immemorial have been something you should be concerned about if you're an investor, no?
Yeah, well, some of the small banks have done very well, and some of the regionals have done very well. People tend to focus on the big cap banks, but the small caps have done exceedingly well. And I would note that there are financials, and then there are financials. You can take brokerage stocks like Raymond James that has done exceptionally well over the past 6 months.
Yeah, says the man standing in front of a Raymond James.
Yeah, I think to the point that I talked about earlier, what you have, I believe, in financial services is what you're seeing across the board in a lot of industries. I'm sure we'll get to talking about Amazon. Cisco was down big.
Let's talk about it now.
Yeah, okay.
It goes up to new record highs.
My point is that in certain industries, you have waves of commoditization that set in. And a company like Amazon, rightly or wrongly, I don't know whether or not they'll be able to compete in the networking side with the Ciscos of the world. I don't really know. We know that all the phone stocks, the phone manufacturers, they all went down when Amazon was going into phone hardware, and that didn't pan out into anything either.
Groceries.
But in financials, you do have, it's just the business is becoming commoditized. I'm not saying that it can't be good, but certainly on the brokerage side, it's not going to be what it was 10 or 11 years ago. It just will not be.
Jeff, look at the stocks like Amazon, which make new highs, and the fact that it's clustered around so few names, concentrated. We've talked about it so many times, lifting the market as a late cycle indicator. Do you see it that way?
First of all, I don't think we're late cycle. I think the downturn was so severe and the recovery so lame that what you've done is elongate the mid-cycle. And I just don't think we're in late cycle yet. And I don't understand the valuations of the FANG stocks. So I use people like Tom O'Halloran at Lord Abbott that runs the Growth Leaders Fund and let him invest in those for me.
What does that say to you, that the FANG stocks that's where the action is?
What, in terms of them not going up?
Are they safe havens in this kind of environment? Are they just earnings?
I mean, I've had this discussion with Mike. You want to know what a safe haven is? The safe haven is a money market fund right now, which is yielding you plus or minus what the dividend yield is on the S&P 500. That is not a bad place to be. Mike has a different point of view, which he's been busting me on for the last 6 months. But the point is this, which is, if you believe that the economy is going to be growing at over 3% going forward, and you believe there is not going to be a trade war, the bond yield curve should not look like the way it does. And so if somebody can explain to me why it looks like the way it does without taking those two things into account, then I'd be happy to.
Foreign central banks.
Yeah. Well, that may be the case, and if that's a different form of trade war, if you're basically talking about currency devaluations to keep basically economies afloat.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.